Nike, ticker NKE, is a company that all of you probably know, and over the past 5 years it is down by 17.21%, and over the past year it's down by almost 30%, very near its 52-week low. Now, one thing I really love about Nike is its very low trailing free cash flow payout ratio of only 33.89%. And this means that after paying out their dividend of $1.48, they still have about 65% of their free cash flow left over to buy back shares, pay off debt, and raise their dividends while investing back into the business, which is extremely important with every dividend paying company. Now, regarding the fundamental 9-pillar analysis, we can see that they have a rating of 7 out of 9 with only 2 pillars in the red. Now, they have increasing revenue, they have increasing free cash flow, and they have increasing net income, which is extremely important because the growth of the company raises its value over time. They also have a 5-year profit margin of 44.50%, which is extremely nice. They have decreasing shares outstanding and consecutive dividend growth of 9.22% every single year on average over the past 5 years. And regarding their long-term liabilities over the 5-year free cash flow negative dividends, this ratio is sitting at 0.94, which means that they can pay off all their long-term debt in about 5 years, so they won't get into trouble with debt anytime soon. Now, jumping to the 2 pillars in the red, the 5-year PE ratio should be sitting anywhere below 22.5. Over the past 5 years, it has been sitting at 29.67, which is higher than what we'd like to see. And regarding the price to free cash flow, that as well has been sitting at 40.76 over the past 5 years. But if we have a look a little closer, we can see that currently the PE ratio is sitting at 22.71 and has actually been decreasing at a rate of 9.11% every single year over the past 5 years. And the free cash flow is currently sitting at only 18.30, which is well in the range we'd like to see. And as well, it has been decreasing by 10.82% yearly over the past 5 years. So overall, the 9 pillars for Nike are looking very sweet. And now let's find their intrinsic value. So after plugging in our 5-year earnings growth estimate at 14.34% into the Graham's formula, we get an intrinsic value of $88.73, 11% higher than the current trading price. For our discounted cash flow model, after plugging in the calculated growth rate at 14.7% into the future and the discount rate at 8.7%, we get an intrinsic value of $168.73, which is well over the current trading price. Now, for the third valuation model, we compare Nike to its competitors and get an intrinsic value of $87.65, which is again above the current trading price, showing us that Nike is undervalued compared to its peers. And finally, to the dividend discount model, we plug in a projected growth rate of 7.5% yearly over the next years and get an intrinsic value of $130.21, which again shows us that Nike is undervalued compared to their very nice dividend growth. And finally, moving to the ultimate valuation, we get an intrinsic value of $118.83, which is almost 50% over the current trading price. And with a margin of safety of 20%, we get an acceptable buy price at $95.06. So it is obvious that Nike as a company, even though there are competitors coming from China, is doing very well. They are growing and their intrinsic value is almost 50% higher than their current trading price. So buying it now almost guarantees a great return in the near future. If you want to watch the longer, more descriptive analysis of Nike, you can click on the video on the screen right now. And if you want to download these spreadsheets for your own personal use, you can also do so at the link in the description. And with that, thank you for watching.